kind of go together. They're pretty short and sweet. And 5-3 work together would just go simply below what you see here. 5-4 will basically follow suit. As you can see, on March 15th, we received notice from the bank of a dishonored check from Christopher Icola, $63, plus $10 fee for a total of $73, memorandum number 121. Okay, what happens when a check is dishonored? That means that it bounced, it didn't clear, they didn't have enough money. So that becomes an accounts receivable. In a normal situation, that would be a sales credit, cash debit. Now, since we don't have the cash, we have to credit cash and debit general for the accounts receivable. March 16th, we paid cash on account to Spinoza Enterprises 135 using EFT, which stands for Electronic Funds Transfer. This is using internet banking. So basically you are transferring money. You must have owed them money. So it's an accounts payable, general debit, cash credit. The last one is using a debit card. We purchased supplies for $31 using a debit card, memorandum number 123. It's just supplies, general debit, cash credit. Okay, 5-4 tends to be the one that people mix up the most, which you'll see why here in a minute. So, as you can see, on July 3rd, we start a petty cash account for $250. Petty cash is still an asset. We are going to debit the petty cash fund, which is just like cash, except we don't have a specific column or account for it. And we are going to credit cash. This is the part on the 31st that is often confused. We paid cash to replenish the petty cash fund, $78, supplies $25, miscellaneous $8, repairs $45. Okay, we list out each one of the things that they give us. Supplies, miscellaneous expense, repairs expense. We debit general for all of those things, and we put the total, which is $78, also given to you in the cash credit. Those are expenses that we incur because a petty cash fund, very simply put, is like $100 cash that a business would keep to buy food or some supplies. So then at the end of the month, we have to reconcile that. We have to make sure it's accounted for in the appropriate accounts. And that is chapter 5.